Here's how I'd start building retirement income with just one stock. SoFi. Yo, what's going on, Premium Chasers? I hope you're having a God blessed day. Every single person that comments down below today is going to get our high IV playbook that maps out exactly how to trade in these extreme IV times that we are living in and collect in some juicy premium. But guys, today we're talking to those of you that have smaller accounts, but you want to start making your money start working for you. And in my personal opinion, I think SoFi is one of the best stocks to sell options on, because the premiums are fantastic. And if you believe in the company long-term, it's a fantastic business model that I believe is going to really take over the world. Their business model is fantastic. Their upsells and funnels are fantastic. The average customer stays with them for obviously many years, but on the back end, they sell them so many more additional products and services once they're inside of their funnels. So today we're going to be talking about SoFi and how we can actually potentially create an income using SoFi as well as options trading. Let's go over the shoulder. We're using Robinhood here for our example today. Obviously right here, I am on SoFi. So I'm going to go over to the Trade SoFi options section. I'm going to click sell a put. On this channel, we are primarily selling options, meaning we are collecting a premium, right, from options buyers. Now, the first thing you want to do when you are really trying to create income when you're selling options is you want to sell a put first. And really, when you sell a put, all you're saying is, hey, I'm willing to buy 100 shares of this stock at a price that I choose. And when you say that, an options buyer will actually pay you money just for saying maybe, okay? Now, there's a few things that can happen. We'll cover that here in a moment. Right here, we are obviously on our options chain, and I'm going to go out about 8 days out, okay? Our current market value of SoFi is $11.23. And let's say I love SoFi at $10.50. If it drops to $10.50, just about $1 in 38 days, I'm totally cool buying 100 shares at $10.50 per share. Now, for that, we would collect $80 in premium. Let's toss that into our cash secured put calculator to see what kind of actual returns we're going to be getting here. All of these calculators are available for free inside of our Facebook group as well. Just link will be down below in the description. Everything is free on this channel, all the training, all that stuff. The only thing, if you ever want to work with me one-on-one, that obviously there is a cost, and that link will be down below in the description. But we are going to put our premium that we collected $80. Our collateral here is $1,050, right? 1050 times 100. And our return in a 38-day period is 7.62% on our money, right? Because we are collecting this premium that we're collecting from this option buyer immediately gets given to us. That is deposited immediately into your bank account, right? That is cash. You can transfer, you go buy gas with it, whatever you want to do, right? And you're getting that for putting up and locking up about $1,000 of your money. That money, right, is collateral. That money tells Robinhood that you have, like, if this thing drops to 1050, you're able to buy it, or you have margin, or whatever, however you're funding your account, okay? So, in my opinion, a 7.62% return in a month is absolutely fantastic. Now, there's a few caveats that we all need to be made aware of, right? If SoFi drops to $9, $8, goes bankrupt, you're on the hook still for buying 100 shares at $10.50. So, you got to weigh those risks for yourself, okay? Now, if SoFi stays above $10.50, right, your options contract will expire worthless, right, and your collateral will be freed up, right, in 38 days, and then you could run the play again and collect more premium. Now, obviously, the more money you have, the more premium you can collect. So, if you had, wanted to buy 10 contracts, right, of this, you'd collect $800 up front, but, right, you would need to put up $10,500, right? Now, again, to me, a 7.5% return in a month is absolutely fantastic. And you really only see these kind of juiced up returns on stocks like SoFi that are a little bit more high risk, right? So you obviously want to go do your own due diligence, but these kind of returns, again, on the more riskier stocks, they're very juiced up like this. On safer stocks like SPY or, ETFs, those kind of things, you're going to see usually between a 1% and 3% return. Again, this all depends on market conditions. Obviously, go do your own research, but annualized in this example, at this time when we were doing this, annualized, if we're able to do this trade 9 times a year, since expiration is 38 days, we can pull that trade off about 10 times a year. If we can, that's about a 73% return. Now, sometimes you're going to be assigned though, right? So sometimes you might close out your position early. Again, this is just a high level thing that I like to kind of see judging when I close out my positions. Okay. So coming back to SoFi now, most of the time our options contract will expire worthless. If it doesn't, not a big deal, right? We get assigned, we buy our shares at 10.50, okay? Now, if we actually get assigned and we actually have to buy those shares at 10.50, we can now do something called the covered call, right? Now, the covered call, our collateral is our shares, our 100 shares that we had to buy, not, right, our money anymore, okay? So we're just going to close out this position right here, and we're going to now select sell a call, and we'll keep our same expiration date here, okay? Now, let's say you bought them at 10.50 and you're willing to sell them at 12. We'll just say 12 so we're not doing a massive, $100 plus collateral here. Now, I'm going to kind of go full, stay with me here, guys, because some of you probably know this, but I want to address a big question here in just like literally a minute. Give me a minute to kind of show this to everybody, and we're all on the same page, and I can show you the caveats. But for example, let's say you bought it at $10.50 and you want to sell it at $12, right? You would collect $85 in premium right here, okay? So we'll go to our Simple Man's Cover Call Calculator, and I will zoom that in. Again, all these are free in our Facebook group. We're collecting, what do we say, $85 in premium here. Our strike of the option, right? That's what we're willing to sell our 100 shares for that we bought at $10.50 of $12. All right. So we bought them for 12. What is our purchase? Our $10.50. We bought them for $10.50. So that gives us a premium return of about 8%. What is premium return? Basically, it's multiplying $10.50 times 100 because you have to do it. Every contract is 100 shares, right? And dividing the premium by it to give us the 8% return. If you sell your shares, right? Obviously, the difference between $12.50 and $10.50 is is $150. So you're getting $150 of profit on the shares for a total profit on this trade of $235 or 22%. Plus, you can add in your premium here that you collected from your cash secured put for $350. Okay, let's kind of go full circle here because if you're a beginner, you're probably confused, and I don't want you to have unrealistic expectations for yourself, okay? So let's kind of walk through this entire thing so you can understand this, okay? There are times, let's say you did buy, let's say on the cash secured put side, when you had to buy it, right? Let's say it dropped down to $8 and you had to buy it, right? You might not be able to do a cover call at 12 and to get this kind of premium, right? You might only get, $16, right? Like if I did the 15s, I'm only collecting $16 here. So just understand that these premiums all adjust. I'm assuming you kind of understand that already, but these premiums all are constantly adjusting, okay? But with that said, if you are sticking to stocks that you believe in long-term, right? You have a long-term outlook on, the worst thing that can happen to you is you are stuck holding a stock for a little bit of time. Okay, until it recovers, and you could do your covered calls again. Now, you can always do your covered calls, right? Let's say SoFi did drop down to, and as you do strategy, this will happen to you eventually because you'll get into something you shouldn't have done, and you did it anyway, even though you were supposed to stick to your plan. Let's say you bought SoFi at 7 or what random stock, right? And you want to, but you were assigned at like the 10.50s, right? You were assigned at the 10.50s. You're trying to do your covered calls 38 days out, but there's nothing really in the over 10.50 that's giving any kind of juicy premiums. So you're like, man, what do I do? I'm jammed up. This stock's trading at $7 right now. I got it at 10.50. What do I do? What do I do? It's a scam. None of this works, right? So what you have to do in that case is, one, you obviously just hold and wait, right? Two, if there is some contracts available, like, making like $9 here on the 16s, you can do that, right? That's up to you. Or you could push out the expiration, right? We can go out here 87 days now. Now, look how much more these premiums actually are. That $9 is now $32. And that's up to you, right? This is where you're going to have to decide your own risk levels, what your strategy is to actually produce an income on these kind of stocks and trades. But again, if you stick to stocks you love, you enjoy, you believe in long term, you're still getting it at a bigger discount as long as you have that belief that it will recover. Okay. So let's go take a look back to this calculator to kind of show you guys. So if on the covered call side, this is when we're putting up our 100 shares as collateral, right? We collect that 8% premium on our shares. If we sell them, now I say if because if SoFi stays below, right, that $12, our covered call will expire worthless, right? Our collateral, our 100 shares will be freed up, and then we can run another covered call and collect more premium and eventually, hopefully, sell our shares and make the appreciation sale, right? And that appreciation sale is this profit on the shares of $150, right? Plus your premium that you collect on your cash secured put, okay? Now, let's quickly talk about how do we try to time the market? What are the best times to get into your cash secured puts, cover calls? So listen, first and foremost, no one knows what the market's going to do, and timing the market is obviously a losing game. But there are optimal times to do cash secured puts and covered calls. Let me show you guys that. Here I'm just using Yahoo Finance. I'm going over to the chart section, and I have an indicator added here called Bollinger Bands, okay? Now, these Bollinger Bands basically tell you a range that a stock is most likely to trade. And again, it's all a fugazi. We don't know what the stocks are going to do. Nobody does, all right? Don't let anybody tell you that they know what it's going to do. But when we look historically, right, if we just look like over the year, right, for the most part, SoFi kind of stays in its Bollinger Band area. Sometimes it drops real low between them, and sometimes it shoots up past its Bollinger Bands, right? But for the most part, we're kind of staying in that Bollinger Band area, okay? So, rule of thumb, right? These Bollinger Band indicator, right? If it's towards the top, that's usually the best time to sell your covered calls. The reason that is because people are pouring into the stock. Obviously, maybe earnings came out, some good news, whatever it might be, right? Shot the price up. That's the best time to sell your covered call, right? Using your 100 shares as collateral, because you can get the best strike price, right? Here, right? Those 16s. Let's say SoFi just it's up 5% today, right? Let's say it keeps shooting up, right? These 16s are going to keep getting more and more juicy for us, right? It's just going to keep being more and more juicy for us, right? As opposed to if it's down 4%, nobody's going to want to buy it at 16 when it's trading at like 8, right? So the cash your put side, meaning we use our collateral, our money to buy those 100 shares, the best time to open those is when we are trading towards the bottom Bollinger Band. That's usually an indicator that there's a sell-off. People are selling the stock off. They don't want it. Terrible earnings. No one believes in SoFi. And that's where emotional control as a trader comes into play. Because, right, you need to be able to stick to your plans. Do you believe in SoFi just as much as you did when it's hitting all-time highs? But now it's hitting lows. Do you still have that same conviction? If not, you need to rework your strategy and come up with a watch list of companies that you actually don't mind holding, right? Because that's what we're doing here. We're essentially long investors, but we're trying to create income from our shares at the same time, essentially kind of like renting out your shares and collecting income on a weekly or monthly basis. So when the stock is trading towards the bottom Bollinger Band, that's when we want to start taking a look at the cash secured puts. For example, when we were talking about this last week, we were trading around $9, right? And we were showing examples, right, of 850 puts that were paying really, really juicy premiums. Because look, it blew past down this Bollinger Band, right? It was kind of in free fall. It was below its 300-day moving average of $10, right? Obviously, we had a nice little rebound here this past week, but this would have been a great time to consider doing some cash secured puts, right? But a lot of people were scared. They didn't know how much more of this could go. But that's where you have to kind of stick to your plan. Now, the cool thing about doing cash secured puts and cover calls is we can close these kind of positions out early, right? So for example, if, right, or when SoFi was down here in this 950 range, right, now it's trading at 11. Maybe your put that you put out there, pun intended, for 850, right, is now pretty much worthless. Nobody wants it anymore. You can buy that contract out and close your position, right, and free up your collateral to then look at different opportunities. Guys, don't forget, drop a comment down below and I will send you my high IV playbook. It's a must read for trading in environments like this, especially if you're an options seller. Make sure to hit like and follow and subscribe to the channel. Remember, guys, sell options, collect premiums, repeat. I will see y'all tomorrow.